Welcome to this explainer. Right now, there's a massive, almost invisible shift happening right beneath the surface of the financial world. We're tracking billions of dollars that are migrating away from flashy, headline-grabbing AI technology and flowing directly into everyday essentials. It's a profound shift in how the biggest players on Wall Street are positioning their wealth, and understanding it is absolutely crucial to understanding today's financial landscape.
Okay, let's jump right into our roadmap. Today, we're going to cover the shift to safety, why the money is moving, how capital rotation works, the market impact, and finally, the risks of the rotation.
All right, Section 1, the shift to safety, leaving the high-tech metropolis.
So, what are the big players actually doing? At its core, these massive institutional funds, the ones controlling billions of dollars, are executing what's called a capital rotation. It's basically a strategy where money is intentionally drained out of one stock market sector and poured right into another. Right now, they're actively selling off shares in those high-flying AI tech companies to fundamentally rewire their portfolios.
So where exactly is all that cash going? Well, first up, it's flowing into value stocks. These are shares of established, time-tested companies that are trading at a discount relative to their current earnings. Big investors are flocking to these because, they offer incredibly reliable financials today, not just promises for tomorrow.
And right alongside those value stocks, they are heavily targeting consumer staples. These are the quote-unquote boring but incredibly resilient companies making the everyday things people just have to buy, regardless of what the economy's doing. Think food, beverages, hygiene products, the whole shebang. Because look, when budgets get tight, you might cancel a software subscription, but you're absolutely still going to buy toothpaste and groceries, right?
It kind of helps to think of this as two extremes. On one side, you've got this high-flying AI tech metropolis fueled by rapid price growth and, let's be honest, massive public hype. And on the other side, the quiet, predictable countryside of consumer staples. Investors are literally packing up their bags, moving out of the volatile city, and settling down in the stable farmland of everyday household items.
Moving on to Section 2, why the money is moving, the changing economic weather.
It really all boils down to playing defense. Institutional funds want to protect their capital by locking in those massive AI gains before a potential market crash happens. They're managing valuation risk by dumping tech stocks that are priced way higher than their actual revenue. And instead, they're hunting for the consistent, reliable dividend payouts that staples offer to really build up a shield against economic slowdowns. Now, we call this the AI reality check. It turns out feeding exciting new AI technology into the corporate machine to churn out actual, tangible profit is proving to be way tougher, taking a lot longer and costing significantly more than Wall Street originally projected. Basically, the hype has finally hit the hard brick wall of business infrastructure. And then you have to add in the broader macro weather. When central banks keep interest rates elevated, investors naturally prefer companies that can hand them reliable cash flows right now, rather than tech companies promising massive profits maybe 5 years down the line. Plus, these tech companies are facing exhausting, sky-high earnings expectations just to keep their stock price afloat. Value companies, on the other hand, have much easier, totally attainable goals to keep their investors happy.
Which brings us to Section 3, how capital rotation works, the hidden machinery.
So how does this actually happen? They don't just slam a giant sell button, because obviously that would cause a massive panic. It's a much more stealthy execution process. First, they crunch the metrics, really evaluating those price-to-earnings ratios to spot overvalued tech. Then, they wait for a trigger. Maybe a tech giant misses a really extreme earnings forecast. After a quick liquidity check to make sure they can move cash safely, they execute gradually. We're talking trading in quiet phases over weeks, sometimes months, accumulating staples without accidentally driving the purchase prices up. And this creates a massive domino effect. By systematically selling tech shares, they flood the market with supply, which causes tech prices to cool down. Then, that cash directly flows right into overlooked staple stocks, pushing their prices up. And because capital is now spread much more evenly across diverse, boring sectors, instead of being concentrated in just a few tech giants, overall market volatility drops. The end result? Flatter growth curves, sure, but a much calmer, safer overall market. Let's jump into Section 4, the market impact, the ripple effect on your wallet. So let's break down the winners and losers here. For tech firms, the wild party is kind of over. They now face intense scrutiny and are going to have to justify literally every dollar of infrastructure spending just to regain trust.
Consumer staples, they get cheaper access to capital and rising share prices. But what about you? Well, if you have a diversified 401k, your portfolio actually stabilizes. The sudden drops in your tech holdings are neatly offset by the steady gains in your grocery and value stocks.
It's wild because the mood on Wall Street has shifted entirely. Analysts have completely stopped drooling over speculative future growth metrics. Nobody really cares what a company might do in 10 years anymore. The only question right now is who has the healthiest, most tangible balance sheet today, and who can offer immediate, growing dividends right now.
Finally, Section 5, Risks of the Rotation, the catch.
So, we have to ask the critical question. Before you rush out and rearrange your entire financial life, is pulling your money out of tech and stuffing it into boring staples a guaranteed, completely foolproof whim?
Well, far from it. There's some serious traps here. First off, if AI achieves a sudden, highly profitable breakthrough tomorrow, rotated capital is going to suffer massive FOMO, just totally missing out on explosive stock growth. Second, those quote-unquote safe consumer staples are actually highly vulnerable to inflation. If the raw materials to make those everyday goods cost more, their profit margins vanish. Plus, executing these massive sector shifts in your own portfolio generates huge trading fees and tax liabilities that can easily eat up your returns.
And then, of course, there is the ultimate hazard, the value trap. A value stock might look incredibly cheap and appealing, but you really have to do your homework. You might buy a cheap stock thinking it's a neglected hidden gem, only to realize the underlying company is actually just slowly going out of business. It's cheap for a very good reason.
And that brings us to the end of our explainer. We've seen exactly how and why the world's biggest funds are quietly migrating from the flash of AI to the safety of the supermarket aisle. So the final thought I want to leave you with is this: take a hard look at your own investments. As this massive wave of capital moves across the market, is your portfolio positioned to merely survive it or to truly thrive? Thanks for joining me, and keep learning.